Tonight, US tech is going to keep sliding because the market makers still need to flush out the remaining panic sellers. But the hotter it dumps, the more excited I get. It's just another chance to scoop up cheap paper. The more I look at it, the more convinced I am that AI's long-term fundamentals are bullish. It's all about holding the line. Just like Warsh said about the near-term US macro fundamentals, it basically took the words right out of my mouth regarding US
So
stocks.
that was strong. I don't want to sound like a Wall Street newsletter and update that with recent events because we follow trends.
So this isn't some AI stat narrative. This is some meticulously designed bull trap by Wall Street. Anyone who watches my videos knows I've been a massive short-term bear on US stock. Honestly, I've been waiting for this correction for a long time. Yesterday action was essentially using meta selling compute narrative to trigger panic, smash the bid, and grab cheap shares. Okay, let's be real. Tech was just way too overextended. As traders, we have to learn to look past the headlines noise and focus on actual fundamentals. Is meta selling compute really because industry demand has vanished? Used to bring. At the exact same time, Meta is selling off its capacity, and Google literally just restrict Germany access due to severe compute shortage. And Amazon AWS is quietly hiking reservation prices for GPUs. What does this tell you? High tier, cutting edge LLM compute is still ridiculously scarce. Meta selling compute is purely because their own operational execution has been lagging and their internal consumption is weak. So they have to monetize it to dress up their upcoming earnings sheet. This is not a systematic industry headwind. It's just a company-specific operational tweak. So if the fundamentals are fine, why is the market using this excuse to smash semiconductor and memory as if the sector is going to do zero? And first, it's just too overextended. A healthy correction is overdue. Think about it. The SLX index reaped nearly 88% in Q2, and memory was even crazier. At the start of a new quarter, of course, institutions are going to lag in profits. And second, the timing is highly specific. The US market is closed on July 3rd, making July 2nd the last trading day before the holiday. Capital de-risk and dreams exposure ahead of long weekends. And when this pre-holiday effect hits high-flying sectors, it easily triggers a stampede. And third, the most importantly, the hidden catalyst, as Hynix is preparing for a US IPO. Pay attention here. Once Hynix lists in the US, its shareholder structure completely shifts. And before it was dominated by Korean retail traders and domestic funds. Going forward, the buyer will be US loan-only institutions, global semiconductor ETFs, pensions, and sovereign wealth fund. And before the new money step in, the old money has to clear the deck. If leverage Korean retail traders pump Hynix to the moon, US institutions would just end up carrying their bag during the next leg up. The solution? Smash the price out right now using headline controversies and thin pre-holiday liquidity to wipe out the leverage loans and check out the weekends. So when you connect the dots, Meta's compute scare, the Hynix IPO, and a pre-holiday effect, this isn't a fundamental breakdown at all. This is just the market running its classic playbook to shake out weekends and reallocate shares, and that's a good thing. Parabolic moves are unsustainable. A slow grind with healthy handovers of shares is how you build a lasting bull market. And finally, let's look at the ultimate sentiment indicator. Yesterday, Wash was on stage pounding the table on AI. Doesn't it feel a bit like deja vu? Many traders instantly got PTSD and remembering how gold pulled back all the way to 4,000 after a massive hype cycle earlier this year. This psychological trigger caused the market highly strong nerves to snap. But here's the catch. During this aggressive sell-off from last night into today, I haven't actually seen massive panic volume, nor have I heard of any traders actually cutting loss. What does this mean? It means the sentiment button isn't quite here yet. In the near term, the market makers will likely keep grinding down your patience, maybe even pushing the price a bit lower, but mark your words, every single irrational flush is a potential golden opportunity. Okay, as always, this is just my personal analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content. Bye-bye. Attention gold holders, this is a rebound, not a reversal. Gold's short-term bounce isn't over yet. Over the next 2 days, we will likely see continued upward short squeezing, but make no mistake, this is merely a bounce, not a structural reversal. Last night, gold got wrecked by 100 in a flash, riding this short squeeze momentum. The market will likely use tonight's non-farm payrolls to push even higher, completely washing out the short sellers. Why this pullback so explosive? Emotionally, the market has been gaslit by relentless rate hike expectations for too long. The previous continuous sell-off made many think gold was dead and leading to a massive buildup of short positions in the futures market. Smart money was zero in on this exact juicy target. When the short side gets overcrowded, even the slightest good news triggers violent upside momentum. This is your classic short covering rally. On the news front, Wash over timely assist stating that inflation expectations and risks have eased. And shortly after he dropped his lines, the market exploded. Why was this single sentence so effective? Because as a Fed chair, Wash words are equivalent to showing his cards to the market. The probability of a rate hike is extremely low. Coincidentally, yesterday lower than expected ADP jobs report confirmed that the labor market and economy are cooling, providing the ultimate evidence for Wash claim. As a result, the rate hike narrative instantly collapsed, sending both Treasury yields and the US dollar index tumbling from their highs. For the long suppressed gold bulls, this was the perfect excuse to charge. Meanwhile, massive shorts panic and scramble to cover. This combined force of long stepping up and shorts bailing out ultimately engineered this rally, and this rebound likely isn't over. And once the dust settles, the probability of continuing to squeeze the shorts remains extremely high. But that's just my short-term analysis. So why do I insist it's a rebound and not a reversal? Because real-time news like wash comments is purely a tool used by smart money to manipulate short-term sentiment and surgically liquidate short positions. It has absolutely zero impact on a medium to long-term trend. Right now, US inflation remains fiercely sticky, heavily fueled by massive AI capital expenditures. The current cooling is purely sentiment. The core inflation alarm hasn't been turned off at all. Again, this macro backdrop, the Fed's interest rate will likely stay higher for longer. Therefore, gold simply lacks the structural conditions for a medium-term reversal. That wrap up the gold analysis. But what actually more telling for July? July is the delivery month for silver. Some might want to bet on an epic industrial spot short squeeze at the bottom. Okay, let me pour some cold water on that right now. Silver currently has absolutely no foundation for a short squeeze. First, there's zero physical shortage. COMEX register warrants surged by nearly 9 million ounces in just 1 week. Deliverable physical inventory is highly abundant, and speculative capital is aggressively rolling over to the September contracts. Second, the underlying industrial logic has shifted. According to the latest data from the Silver Institute, global solar silver demand in 2026 has plummeted 90% year over year, and photovoltaics are no longer a bottomless pit draining silver, and the automated industrial buying floor logic has fractured. Therefore, with abundant physical supply killing the short squeeze stream and shrinking solar demand weakening industrial bits, silver's driving logic moving forward is crystal clear. It's fully reverting to trading off the Fed's interest rates and the US dollar index. In the short term, silver would just obediently shadow gold this week, inviting the cocktails of this short squeeze sentiment to push higher. However, looking at the medium term, once rate hike expectations reignite under a macro backdrop of shrinking liquidity, silver will bleed right alongside gold, and its crash will likely be far more vicious. Okay, this is just my personal analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content.